My name's Richard Yorke. I'm one of the directors of CoStar here in the UK and Europe. I look after the sort of analytics and sort of product side of the business. Today's, or rather this morning's presentation and panel falls into three very logical sequences. I'm going to talk about sort of the investment trends over 2017 and sort of drill into those. Mark is then going to carry the ball and talk about what's happening in London specifically, and also what might happen in terms of 2018 and 2019. And then Paul Norman and his august panel are going to obviously reflect on the kind of the themes and the data and the analysis that's come out of today's presentation. Now, before I start getting into the slides, I should always, just reiterate that all the data, the charts, the analytics, the commentaries, all available to you, our clients. We haven't just created lots of stuff on the fly just for today's or this morning's presentation. All this is available, and much of the content you're going to hear about this morning comes from the investment report that we produce every quarter. We published this about 2 weeks ago. Goes into a lot more detail than we can understandably cover this morning. I do please urge you to read it. And some of the other content you'll see and hear about today comes from our brand new national office and industrial reports. We only produced these for the first time about 2 weeks ago. They're a bit different in that they are updated on a daily basis. They very much focus on the occupier side of the market, looking at absorptions and deliveries and take-up and so on and so forth. As I say, they're based off our real-time data. They change on a daily basis, and some of the charts that you'll see today have been very much informed by these. So that's the kind of the sales pitch done. Let's get on with the analysis. So the starting point for today is really firstly just to think about where we were this time last year, because as they say, a year is a long time in politics, but it's a long time in just about everything, I guess. And so if you cast your minds back to where we were at the beginning of 2017, looking back on 2016, 2016 was definitely a year of surprises. Here's just a few of them. Leicester City winning incredibly, Brexit, Donald Trump, Sam Allardyce becoming England manager, Sam Allardyce being sacked as England manager, probably not that surprising. Ed Balls coming across as someone actually slightly human, who would have thought it? So 2016 was the year of surprises. 2017 was the year of surprising calm, actually. I think many of us went into 2017 feeling slightly concerned or maybe even worried about what the future might hold, given those turbulent events of 2016. And certainly we continue to have a kind of bellicose president tweeting to his heart's content in the early hours. But despite his kind of verbal jousting, we haven't slid into World War III quite yet. Brexit obviously dominated the news agenda, dominated politics, and we're probably all very bored of it. But it didn't have the kind of cataclysmic effect on the economy yet. GDP growth in the UK was 1.5%, not quite sort of the trend of 2% or the 2 and a bit %, but certainly not a recession. And as well as kind of reasonable GDP growth, we've seen record employment levels. Never have so many people been employed in the UK, which is pretty remarkable. And the manufacturing sector is doing quite well. Exporters are doing quite well too. The Eurozone, despite that kind of strange German election, which hasn't quite concluded, they're still trying to figure out exactly what that government's going to look like. Some things still unresolved. The European economy was very strong. I mean, yesterday it announced that it is enjoying its fastest growth for 10 years, albeit that's against a pretty meagre historic trend, and they've clearly enjoyed the sugar rush of low interest rates and QE, but nonetheless, the Eurozone doing pretty well. And in fact, the whole world economy is doing very well. I think most independent forecasters have sort of upgraded their forecasts for global GDP and trade. For the first time in 10 years, all the major regions, Asia, Americas, Europe, are growing simultaneously. And that's the first time for quite some time. And that growth has led some people to begin to upgrade their views about where inflation and interest rates are going. Maybe based off what Mark Carney said probably less than a week ago, that interest rates may creep up more quickly and more rapidly than many had kind of thought was possible or probable. And that certainly spooked the markets last week. We saw a lot of volatility. But a lot of those losses have been made up. And as a business, CoStar, we are cautiously optimistic about the economy, about the market. We took new space in Birmingham last year, so really doubling down on our commitment in Birmingham as a market. And we consolidated some of our existing space in London to take up the 26th floor of the Shard. Thank you very much to some of the people in the room who gave us that advice. But it made sense for us to consolidate our space like that. So, relatively benign conditions to a degree. And that's very much reflected in some of the data that we have been tracking over the last year. And so the first set of charts I'm going to look at is total investment. So this is investment going into offices, industrial, retail, and things like student accommodation and the build-to-rent sector, alternatives, as it tends to be called. And as you can see here, about 62 billion was invested in UK commercial real estate. That was, I think, way higher than most people would have expected at the beginning of the year. A good 27% higher than the year before, and way above the 10-year average. So, a surprisingly strong year. And I'm sure you've heard similar things from other industry bodies and commentators. It was slightly down on those kind of heady figures achieved in 2015 and 2014. Well, I guess many people thought that was pretty much the top of the market in many respects. But a very, very strong, a very credible performance. And if you then start to break down that performance by over the quarters, you can see that actually investment volumes really began to ramp up through the year. Each quarter getting stronger and stronger. And I think Q4 was probably the strongest quarter for about 3 years. So we really did end off on a high note. So maybe some cautious optimism at the beginning of the year. But as the year progressed and maybe things didn't seem to turn out as bad as some people might have thought, I think people became more confident about the economy, more confident about the market, and you can see that in some of the investment flows. So a pretty strong story there. Of course, the real estate market is much more nuanced than that. It's more complex than that, and we see divergent trends at the sector level, at the market level, individual property level. And so I'm now just going to look at sort of 5 key themes that come out of our data, which we think are quite interesting, and some of the things that our panelists can reflect on. So in terms of key themes for 2017, well, one of the outstanding key themes was the growth in alternatives and industrial demand. And as you'll see from the next chart, this just shows what's happened to investment volumes for offices, industrial, retail, hotel, student accommodation, build to rent, so on and so forth. All the major property types saw growth between 2017 and 2016, with the one exception being retail. Retail fell by about 10%, and I'll talk a bit more about retail in a second. But as you can see, the standouts were those alternative sectors, the student accommodation, the build to rent, incredibly strong growth. Student accommodation nudging up to sort of 5-6 billion. We saw a lot of activity there, not least IQ students' purchase of the pure student portfolio. That went for about 900 million, so nearly £1 billion spent on a student portfolio. That was one of the largest deals of 2017. Just gives you an idea of the kind of growing demand for those kind of assets. And then built to rent, similarly, growing very, very rapidly. LSH did a quite nice piece of work. I always like to give a shout out to our clients, looking at some of those hotspots for build to rent, much of it in those kind of southeast towns, university towns, which have a tech cluster or other kind of clusters of kind of business services. Actually, in some respects, some of those places seem quite logical. It's nice to see some evidence behind that. So student accommodation sector, build to rent, really growing really rapidly, still quite small compared to the office sector. But you just have to look at the US, where the multifamily sector is the largest real estate sector that you can invest in, and the direction of travel is pretty clear. And the next chart I think is really interesting because it does show a potential inflection point. So this shows investment in office, retail, industrial, hotel accommodation, build to rent over the last 5-6 years. And you can see, a bit like Ghostbusters, we're seeing a crossing of the streams. That alternative sector, and we probably need to actually call it something else. But alternatives, as you can see, has eclipsed retail in terms of investment volumes, which is quite interesting. I don't think many people would have expected that even a few years ago. That's partly due to the weakness of retail, but clearly there's a lot of strength in that hotel, student accommodation sector. Industrial also continues to go from strength to strength. And then looking back to 2011, it is remarkable how close retail and offices were. 2011 wasn't that long ago, but a chasm has opened up between the office side of the equation and retail. Now, going back to industrial, again, we saw phenomenal growth. Investment volumes edged up to about 8 or so billion pounds in 2017. These are sort of near record numbers. 40% increase in investment activity. We tracked at least probably 10 or a dozen portfolio deals over 100 million in industrial, and we've seen strong demand at both ends of the industrial market. Obviously, at the very large end of it, those big distribution centres occupied by the likes of Amazon and others, strong demand there, and we're seeing a lot of new construction being put into that end of the market. But also incredible demand for those kind of last mile urban logistics type operations. I think Blackstone and M7 bought the Dunedin industrial portfolio, for about 600 million last year. That was one of the biggest portfolio deals we tracked. And that was a real mixture, and you had a lot of sort of urban, last mile type operations in there. So huge demand for that kind of space, those kind of spaces. And that certainly fueled that appetite, particularly from foreign investors. So this shows the amount of invested by non-UK investors in the market. Grew by 50%. Again, a phenomenal number. No doubt, partly, foreign investors are taking the opportunity to make hay when we have this. When we had the correction in sterling. Sterling has fallen 15% or so against a basket of currencies. Certainly in 2016, it strengthened a bit against the dollar. Still around 1.12 against the euro. So certainly, foreign investors taking the opportunity to buy while the pound still remains relatively weak. But clearly, those big structural factors and changes that are going on, that shift to online retail is very much driving this part of the market. But also manufacturing, as I said earlier, is also doing quite well. And our investment numbers would be even bigger if we included these two enormous corporate deals. Because those are we count those as corporate deals, they're not actually reflected in our investment report. But if you did include those two deals into our data here, then you would see a phenomenal increase in industrial investment. So very much flavour of the month, but not just flavour of the month. I think those deep long trends are very much driving things. Okay, so that's alternatives and industrial. As the industrial market thrives, the retail market definitely becomes much more challenged. As I showed you earlier, the amount of investment going into retail fell by about 10% last year. And as a share of the whole investment pie, it's fallen quite dramatically. It accounts for about 16% in 2017. That's less than half, based on my meager maths, of the average over the last 2019 to 12. Again, 2009 to 12 wasn't that long ago. So clearly people have got much less keen on retail relative to those other sectors, like the student accommodation sector and elsewhere. And clearly, the internet phenomenon, online shopping phenomenon is not unique to the UK. But if you look at some of the data, the UK is very much at the forefront. And this next chart is quite interesting. This shows the kind of the online penetration across a whole a basket of countries across the EU. And it compares amounts spent online over the last 3 months in 2017 against 2008, comparing the UK and other markets. As you can see here, in the UK, we are very much addicted to online shopping. We do more online shopping than just about anybody else in the world, it seems. Or maybe we're just very lazy. I don't know. But that certainly is very much driving what we're seeing in terms of those investment trends. But again, it's a bit more nuanced than that. When you look at the subsectors within retail, as you can see on the next chart, you see something quite interesting. Shopping centre investment has been falling pretty rapidly since early 2014. Only about 2 billion, I think, was traded. That's probably one of the lowest figures, if not the lowest figure we've recorded. I think literally every trade or every shopping centre was bought by a local authority. I think there were very few institutional purchases, and we can get into the wrongs and rights of that. So there's still deals being done in the shopping centre space, but virtually all of them are being acquired by local authorities, and I think for not just classic commercial economic reasons, if we can get into that. But interestingly, retail parks have done much, much better. They've actually grown, and they've certainly, obviously, I think, benefited from that kind of shift to omni-shopping, omni-channel shopping, people using retail parks for big box retail, but also for leisure, for eating. It's very much part of that mix. And we tracked a number of very interesting retail park deals last year by some very canny investors, like people like Tristan or Blackstone and others. And the supermarkets kind of bumping along. We've seen a decline in 2016, some recovery. Obviously, again, we're seeing a picture where the likes of Lidl and others, those challenger brands, are doing well, and the more established brands, the Tesco, Sainsbury's, finding things more difficult, and obviously, downsizing parts of their portfolio. But as you see, that shift from centres to retail parks is quite an interesting one. And it'll be interesting to see how that transpires in 2018. 3 more things to quickly look at. And the next one is foreign capital, particularly going into London. Last year, we tracked around £24 billion worth of foreign investment. That was probably £5 billion up on the year before, so a large amount of that investment coming into London, into the UK. About 80% of that foreign investment is going into London, and it is buying these big trophy assets, many of which you can see through the window here, which is very convenient. Leadenhall Building, the walkie-talkie bought by LKK, the soy sauce people. Clearly, there's a lot of money to be made in soy sauce in China. If you're the number 1 soy sauce person in China, you can buy a £1 billion building. So we saw huge amounts of foreign capital coming into there, and also Canada Square as well. So foreign investors clearly making the most of that currency play. But also, I think this is a really important trend. These are meant to be long-term investments, long-term holdings. I think that's obviously, we think that's a very positive sign as to their perceptions of the enduring strength of London as a global capital, a global financial capital. It's still a city of 8 to 10 million people, depending how you draw the boundaries. So a lot of money chasing those very large assets, fantastic tenants, fantastic covenant strength, and all the rest of it. But it's not just Asian investors, as important as they are. As I said, about 24 billion came in from foreign investors over the last year. And this map just gives you an idea of where they're coming from. So much of it coming from Hong Kong, Singapore, China, going into those large, those London assets. But we saw a lot of South Korean investment coming in, particularly into the regions, both in terms of office and logistics, interestingly. And I think one of the things a panel might want to think about is, is how much more investment can come out of that region, particularly out of China, if they do have stricter sort of currency controls. Germany is an interesting one. After a period of very little activity, over 2 billion was invested by German investors in 2017. I think the standout deal was the Decker deal, the Cannon Place deal for about half a billion. So despite all the Brexit uncertainty and everything you read in the papers, particularly if you read The Guardian, European investors are still coming into the UK. And we saw obviously investment from Canada, investment from the US. So interestingly, actually, US were net sellers last year. So maybe they know some things that we don't. So a lot of foreign capital attracted to the UK. Much of it, 80% of it, attracted to London. That's one of the reasons why London's done so well. However, again, the story is a bit more nuanced if you look a bit more deeply into the data. And if you look at the number of office transactions in London, you can see actually the number of transactions has actually fallen. So there were actually fewer deals in 2017 in London than in 2016, and is actually below our kind of our sort of 5-year trend. So there we saw some very large deals, very glamorous deals, some headline-grabbing deals. The number of deals actually fell. And then looking at our data, it seems that investors have become more cautious about London. Certainly attracted to those very prime buildings, but maybe taking a more cautious view of less prime buildings, or older buildings, or buildings with higher vacancy levels, whatever. And again, Mark's going to get into the detail of what's going on in terms of the London occupier side of things. But that's quite an interesting statistic. I don't think many people have identified that. Two more things to quickly run through. So, while London, did well in terms of that foreign capital going into big assets, I think one of the strongest stories from 2017, actually maybe the strongest story for me, was how popular the regions became. So this first chart just shows the split between London and the regions. About half of the investment, half of that, 62 billion, was on London. About half of it was on the regions. Sort of 50-50 split, not dissimilar to some of the things that we'd seen previously. But I think the next slide is really interesting, and this breaks it down by quarter. And as you can see, the amount of money going to the regions, or the regions' share investment, really accelerated through the year. And as you can see with the dot, it came to 60% of investment. That's a 10-year high. So, I think there was a lot of, I guess the beginning of the year was all about London. As the year progressed and people became more confident, actually the story became less about London and more about the regions. And we've seen that. And over the course of, over 2017, I think we tracked about 5,000 deals in total. Many thousands of those were in the regions, and we tracked some spectacular deals right across the country. And much of that was driven by domestic investors. And you can see on the next chart, after a period of relative decline, UK investors are now spending, have really started to whet their appetite. And we've seen an interesting turnaround in the amount of investment coming out of domestic investors, much of it going into the regions. And you can see some of the biggest buyers of assets. Legal & General literally spent about 1.3 billion last year on dozens of assets, office and logistics, built to rent right across the country. IQ Student, I mentioned them. Tristan Capital bought some interesting properties in Croydon and elsewhere. Apirose, I didn't really know much about them, bought a very large hotel portfolio, bought the Taunton Fire Control Centre, which has like a 30-year lease to the local fire agency. Columbia Threadneedle, M&G. So a lot of investment, coming out of those domestic players, particularly the funds, the REITs. They do seem to have an increased appetite for the regions. But probably the biggest individual investors over the last year remained the local authorities. They spent nearly 2 billion in 2017. That was up on even 2016's big number. And these numbers are far and away bigger than what we'd seen previously. Much of that came in the second half of the year. And as I'm sure you're aware, the local authorities have access to pretty cheap central government funding. They can borrow at 2% and buy assets yielding 5, 6, 7, 8%. And they're doing that to help sort of plug some of the gap in their budgets. And as I alluded to earlier, much of that has gone onto shopping centres. And we've seen them gobble up a number of centres in places like Banbury or Shrewsbury or Bootle here. These aren't just purely for commercial reasons, though. They're part of those kind of wider regeneration, placemaking reasons. And that does make sense. It may be that a truly commercial entity might not view the opportunity for Bootle in a way that the local authority does. But it's interesting that, as I say, the main buyers of shopping centres last year were local authorities, and it'd be interesting to see how that plays out. And then finally, linked to what I've just shown you, is what was happening with yields, particularly industrial and regional yields, and prime versus secondary. Now the next chart, or the next slide, is a bit busy, so you'll have to bear with me. It's been taken directly out of the report. As you see, the average all property yield is on the left-hand side, and basically it's come down. It's less than 7%. It's about 6.7%. It kind of rose for a period in 2017, but as I say, it's come right down. The middle chart is really interesting, and we've seen a huge amount of yield compression, particularly in industrials. But as you can see, industrial, retail, and office have really started to bunch together towards the end of 2017. And again, we can get into detail of that. And then the yield between London and the regions has also come right down. So clearly, investors have seen an opportunity there. That's reflected in our numbers. We just to see how that plays out. And just some of the deals that we saw last year. The Schroders deal in Manchester. I think that was the single largest deal we've tracked in Manchester. I mentioned LNG. The Knight Frank deal was very interesting. Actually, Knight Frank bought that on behalf of a South Korean pension fund, who also bought, I think, another 3 assets, and also saw the Royal London deal in Birmingham. And finally, my last slide just shows what's happened between prime and secondary yields. And for a period, particularly over 15 and 16, that yield gap closed. People were a bit more bullish maybe. It started to open up again in 2017. Again, maybe I think that's partly a reflection of investors trading those large London assets. And maybe there's been some shift to sort of safer assets in London maybe. But clearly that gap that's opened up does create opportunities for investors.